All right, welcome to the Explainer. Today, we're going to crack open the real estate syndicator's playbook. Think of this as your insider's guide to those financial models you see so you can really understand how those incredible returns get put together. Let's get into it.
You've seen it, right? You get this slick investment summary promising a juicy 18% IRR. And it looks like an absolute home run. But you gotta ask yourself, is that return coming from a genuinely fantastic property? Or is it just the result of some clever work on a spreadsheet? That is the big question we're digging into today.
It really all boils down to this one difference. On one side, you've got what we'll call optimistic underwriting. It's based on solid data, but it kind of hopes for the best. But on the other side, you have financial engineering. And that, my friends, is a whole different ballgame. It's all about pulling specific levers in a spreadsheet to cook up returns on paper that the actual property could probably never deliver in the real world.
So to really get to the bottom of this, we're going to walk through the playbook step by step. We'll start with that seductive promise, then we'll expose the biggest trick in the book, the exit cap rate. We'll see how income gets puffed up, talk about the IRR fantasy, and then we'll decode the profit split. You're definitely going to want to stick around because at the end of all this, you'll have your very own red flag guide.
Okay, so what's the goal of all this financial engineering? Well, it's pretty simple. Take a totally average, maybe even mediocre deal, and make it look like a grand slam in the pitch deck. It's about writing a story that's just too good to pass up. Now let's see exactly how that story gets written. First stop, and honestly, this is the most important one, the exit cap rate. If a financial model was a car, the exit cap rate is the gas pedal. It is, without a doubt, the single most powerful and maybe the most dangerous lever in the whole projection. Just look at how simple this formula is. The property's value is just its net income divided by the cap rate. Simple enough. But the real secret, the real power, is hiding in that bottom number, the denominator. Because it's a divisor, even a teeny tiny change to that cap rate can create a massive swing in the final price tag. And this shows the trick perfectly. See, the home run model just assumes you can buy a property today and sell it in 5 years at the exact same cap rate. But a more conservative, realistic model prices in risk. It assumes, hey, the building is going to be 5 years older, the market might change, so the exit cap rate should probably go up. Here, it's just by 0.5%. So what does that tiny 0.5% difference actually mean in dollars and cents? Well, for a property with about $1 million in net income, that one little assumption creates a value difference of over $1.5 million. Poof, just like that. Let's really let that sink in. For a deal trying to raise, say, $5 million from investors, that one single aggressive assumption just manufactured a huge chunk of the projected profit. If things don't go perfectly, if reality is just a little more conservative, that one lever could literally wipe out almost a third of the investor's entire projected profit. The takeaway? This one number is a very, very big deal.
Now, the exit price isn't the only place these numbers can get massaged. The manipulation also happens in the day-to-day operations. It's all about making the income look a little bigger and the costs look a little smaller than they're ever likely to be.
This usually happens in a couple of ways. First, you get these ghost income streams. That's projecting revenue from new fees like valet trash or some new tech package that haven't even been tested in that market. The second way is a little sneakier. Hiding rent concessions. The building might say it's 95% occupied, which looks awesome. But if they had to give away 2 free months of rent to get people in the door, the real economic vacancy is way, way higher. Now, on the cost side, this is one of the most common games you'll see. A sponsor might show property taxes going up by just a little bit, maybe 3% a year for inflation. And on the surface, that looks pretty reasonable, right? But here's the reality check. In most states, when a property is sold, it triggers a tax reassessment based on the new, higher price. So what really happens is the tax bill can literally double overnight in year 2. That just completely torpedoes the cash flow projections for investors. If you don't see that big jump in the model, that is a massive red flag. Next up, let's talk about the internal rate of return, the IRR. This is the big, flashy headline number that a lot of investors really focus on. But here's the thing. Because it's a time-sensitive metric, it is unbelievably easy to manipulate. Here's a classic move. The sponsor uses a short-term loan, it's called a subscription line, to buy the property. Then they wait maybe 3, maybe even 6 months before they officially call your investment capital.
By making the time your money is in the deal shorter on paper, they can pump up the IRR calculation by several percentage points, even though the property hasn't made one extra cent of profit. It's pure financial gamesmanship.
Another fantasy you see all the time is baking in a huge refinance. The model will show this big cash out event in year 3, which pulls a ton of the return forward and makes that IRR number look amazing. The problem? That refi is completely dependent on what interest rates are doing in the future. If rates are high when year 3 comes along, that refi might be impossible. And just like that, the projected return, it just vanishes. All right, so let's say the deal does make a profit. Great, but how does that profit actually get split up? Well, that's all laid out in the profit-sharing agreement, which is called the waterfall. And trust me, the tiny details in here can make all the difference in the world.
Let's zoom in on 2 really critical clauses you have to look for. First is the GP catch-up. This means after you get your initial preferred return, the syndicator might get to take 100% of all the profits after that until their own share catches up. This can seriously cut down on your final payout. The second is a non-compounding pref. Basically, if they miss a payment to you, you don't earn any interest on it. It's like you're giving them an interest-free loan.
Seriously, of all the terms you can find buried in that waterfall, most experts will tell you the GP catch-up is the most dangerous. It's usually deep in the legal documents, but it can completely change the math and shift a huge amount of the profit away from you, the investor, and into the general partner's pocket, especially on a really good deal.
So we've walked through the playbook. You've seen the tricks. Now what do you do with all this? Let's turn this insider knowledge into a practical toolkit you can actually use when you're doing your own due diligence.
Here are 4 killer questions you should be asking for any deal that comes across your desk. First, stress test their model. Ask them, what happens to the IRR if the exit cap is 1% higher? Second, demand proof. Can I see the tax assessor's worksheet for the post-sale value? Third, check their assumptions against reality. And finally, get crystal clear on the profit split if things don't go according to plan. If you only remember one thing from all this, please let it be this. A really great deal can be modeled conservatively and still look good. A mediocre deal needs financial engineering to look great. At the end of the day, true value has to come from the asset itself, the great location, the solid building, a smart business plan, not from some fancy spreadsheet. And that's really the question I want to leave you with. The next time you're looking at an investment opportunity, just step back and ask yourself, is this deal built on solid real estate, or is it built on a fragile spreadsheet that could completely fall apart if just 1 or 2 assumptions turn out to be wrong? The answer to that question will tell you everything you need to know.